Hello out there. Welcome to Macro Mondays. My name is Mikkel Rosenwald, and we're sending to you live from Copenhagen from our studio here. With me, as usual, Andreas Dino. Welcome to the show.
Thanks, Mikkel. Great Monday.
Great Monday.
Yeah.
Has been a lot of great stuff to talk about. We have I have a very, very packed script for today, so a lot of ground to cover, Andreas. We had our Christmas party on Friday. Thanks for that. It was a great one.
Yep. I don't think we should mention what we talked about there, but
no need for that. A lot of good food. Let's just keep it that, Andreas.
Yeah.
It's been an eventful week and weekend, both in geopolitics. We're going to cover that a little bit, and then also in China as well. Some news out of China. We have a heavy week to look ahead to as well. So we've got a lot to cover, Andreas. Before we get to that, just a couple of teasers or announcements here.
Mm.
Tomorrow, you're doing your very first State of the Union show on Real Vision.
Yeah.
Could you just put some words onto what can people expect? The same shit as here, or?
Well, the State of the Union, it kind of tells what we're going through, right? We'll look into the state of the macro union across all major markets, basically. So we look into China, we look into Europe, the US, Japan, etc. And then we conclude with a session on how to trade it, basically. And it is a model package-driven show. So I'll go through our entire landscape of macro models from China to the US, you name it, all asset classes covered, including crypto.
Great. Andreas, we're about 2 months into Real Vision. Been on the platform for about 2 months. I know we've been there longer, but our articles as well. So remember, you can check out all the research that we publish in Real Vision with the Pro Macro package. We have both your weekly editorial. We have an article on what we told hedge funds this week, one which I really like, and a lot of other stuff to cover. But of course, you can also watch it and watch some of it in this show. So that's where we'll head into right now, Andreas. Sorry about that. So, Andreas, I just wanted to start in Syria. Events unfolded very, very rapidly over the last 14 months. I think I counted it. We've had a civil war there for 13 years. Now an offensive by both the northern forces and the US-backed southern forces in 11 days toppled the Assad regime. Have been in power for half a decade in Syria. Does this really matter for markets much, or is it more of a geopolitical thing?
Oil is up today, but I'm not sure it's driven by the events unfolding in the Middle East over the weekend. We've been talking about the potential geopolitical risk premium in energy markets from the conflict between Iran and Israel. And I guess you could argue that this is some sort of light proxy of that as well. But in my opinion, and pardon my French here, it seems like Iran is basically beheaded, if that's a way of putting it. They've lost ground in Syria, they've lost ground in Lebanon, they've lost ground elsewhere, right? What's the next step for them? They don't have any allies left, it seems like. This is put in layman terms, right? But it seems like they're struggling right, left, and center.
They are. They've had some serious fallout after the October 7th attack. They have managed to disrupt the Israel-Saudi normalization talks, which was a huge goal for them. But the costs of that have been very, very huge for Iran, obviously. That's also why we're seeing them sending signals that they would like to talk about a new nuclear deal with the US. I don't think that's going to happen with the new Trump administration, but they're trying to send some of those signals anyway. In any case, Andreas, I find this to be another sign that we are entering into an era of slightly less geopolitical risk. I might look like the stupidest man alive if something big happens next week, but that's the way I see it right now, essentially. So mostly good news. A very, very big refugee discussion entering over this. We have millions of Syrians, especially in Turkey, but also in Europe. We'll have to see where that heads. In other news, Andreas, news out of China, bazooka news, essentially. We've talked about this channel, Fiscal bazooka. I see other people trying are beginning to use that term as well.
Yeah.
So I saw this this overview of the Chinese monetary policy. What's the change you're seeing right now?
Okay, so the short version of this morning we got the news from the Chinese authorities, so basically the Politburo, the leadership of China, essentially, that they intend on embracing a so-called moderately loose monetary policy. And, interest rates are close to zero in China, so you could argue that it's loose already. But it's a big thing when the Politburo admits to monetary policy being moderately loose. When was the last time we got exactly such a shift in rhetoric? It was on November 5th in 2008. And for those of you who were in the game back in 2008, 3 days later, China basically posted the biggest fiscal package in China's history. 3 days later. So I actually think, I was very skeptical over the course of the autumn with all of these messages from China that we're considering fiscal stimulus, etc. I think this is big.
This is it.
It's probably it. So, we know that they have a scheduled meeting this week among the leaders in China. We'll probably get some news already Tuesday, Wednesday. I don't think we have like an exact scheduled timing of a press release or something to look forward to, but this is big. It could be really, really big news. And how do we trade this, right? Or what's the trade here? Chinese equities are up, 7% in dollar terms today, something like that. It's crazy. But commodities like copper, silver, etc., they've traded on the weak side for quite a few months in a row. I think they look very attractive from a risk-reward perspective. We've thankfully been in that copper trade into this, so made a lot of money on that this morning. But in any case, I'm using a historical analogy here. They moderated this language 3 days ahead of the bazooka in 2008. Is it the same this time around? Who knows, right? But it could be potentially very, very big move since it's, they kind of set the scene for something big happening here. So bazookas aren't just reserved for Middle Eastern terror groups. They can also be used in China.
And I mean, it comes down to this a lot of the time when we try to analyze China. We do get numbers out of there. We try to make our own numbers on what's going on in China. But it very, very often comes down to some sort of headline poker where we're trying to play here. But very, very interesting, very intriguing. We'll follow up on this next week. This might be a good time to give our usual disclaimer. We're going to run down we're going to run through a couple of cases you've made this week. But remember that all these trade ideas, all these suggestions, they may be...
Sometimes may be good, sometimes may be shit.
Exactly. Our usual catchphrase from Gennaro Gattuso. Anyway, Andreas, I want to talk central banks. And I want to start out with perhaps one of the most deciding numbers on one of the numbers most decisive for the US rate policy, the non-farm payrolls for last week. More or less as you expected?
Well, yes, yeah. It looked okay on the surface. It was not. So let me give you a few reasons why. If you look at the sort of median duration, for example, of unemployment, it's ticking up, and it's ticking up rather fast, which is something you typically see towards the end of an employment cycle. And, I've been banging the drum on upcoming weakness in labor markets for a few quarters. I've been mostly right on that, I think. It's not necessarily a big issue because unemployment/employment lags everything related to equity markets, crypto markets, etc. So basically, as a business owner, you take decisions on the back of outdated profit numbers because you don't really have anything else to take decisions based upon. So everything that we're seeing right now in labor markets is a result of the weakness we saw in profits back in 22, 23. Why is this important for bond yields? Well, it's important because the Federal Reserve cares. And they've been searching for a political excuse, in my opinion, to cut interest rates in December. They've now gotten one.
This is the pretext they needed, perhaps.
Yes, exactly. And the next question is whether they can cut in January as well. That's not priced in at all, in case they get there. We're probably running at, say, 150K jobs added a month, which is insufficient to keep unemployment where it is. So to me, this is another confirmation that the Fed will keep cutting into what seems to be a very strong equity crypto market, right? So it's hard. It's hard not to celebrate this. And the market went bananas after the release of this non-farm payrolls report on Friday.
Absolutely. One topic we've got a lot of questions on, and I should mention that you can post your questions live, and we'll try and get around as many of them as possible during the show. But one question we've had a lot, Andreas, is the link between the central bank policy in Europe, UK, and the US. It seems to be that markets are splitting on the expectations. What's causing that, and what do you expect over the next few months?
Okay, let's start with what's in this chart, right?
Yeah.
We collect hedge fund data day in and day out on how they trade in various asset classes and how they position. And if you look at the light blue line here, which is the Euribor contract for December next year, markets are betting on Euribor futures to rise in price, meaning that bond yields will have to drop, right? Or the Euribor interest rate will have to drop. While the opposite is the case for the SOFR interest rates, or the dollar equivalent, right? The gap between the two is one of the most bizarre gaps I've ever seen, positioning-wise, meaning that markets are chasing interest rate cuts in Europe, but they're not chasing the interest rate cuts to the same extent in the US. And is this an issue? Well, it leaves the market very vulnerable to bad news from the US, right? Should we get a soft inflation report this week? Should we get some weak labor market data and all that? A lot of these hedge funds, and remember, they're very quickly in and out of trades, right? They could turn around on this view that dollar interest rates will have to go up relative to what's priced in right now. So the main purpose of showing this chart is that, well, I think there's still a very good case to bet on lower bond yields in the US, despite this bazooka from China. And, if we add lower bond yields to a bazooka from China, oh boy, it looks promising for the commodity landscape all of a sudden. To some extent, also okay-ish for the crypto landscape. But, good old industrial metals, they look pretty solid from a risk-reward perspective here, if I'm right.
Very interesting, Andreas. Let's return back to Europe here. You wrote in your article on Sunday about a potential, perhaps it's too much to say, comeback for Europe, but some positive wins. What are you seeing out of our current regime model here?
Well, Europe is not doing as bad as feared. That's kind of the story I'm touring with right now. We've been talking about the weakness in Europe through the autumn, and it's been mostly right to call for that weakness. But all of a sudden, when you get bond yields substantially down, which we've basically seen 2-3 quarters in a row in Europe, and you get to a stage where expectations are extremely low, then you can get a positive surprise. And the light blue line here basically measures whether growth will accelerate or decelerate from the current state. So, we're currently modeling around 0% growth or whatever in Germany, France, and those countries.
Yeah.
So,
doesn't take much to
an acceleration from there. Well, it's not like it's something worth popping the champagne for, but in any case, I think there are a couple of interesting equity cases in Europe, not least France, due to the clear link to the Chinese stimulus. You could also argue that Italy, to some extent, is linked to that. Look at it this way. Stimulus in China, buy Prada, right? If you know what I mean, or buy Moët Hennessy or whatever. That's the kind of stuff they buy. They don't want to buy the shit that they produce themselves. Maybe outside cars.
That's the thing.
Maybe no, but who's ever heard about a Chinese luxury brand?
It depends how you define luxury, but absolutely. I mean, absolutely. I think the thing is that the Chinese government can mainly, perhaps, or what we've seen so far is that they've mainly had an ability to increase spending within the upper echelons of the consumer class, and they buy the luxury brands. They don't buy cars because they've already got one. So to get the middle class out there spending more money, that's still the challenge for China. We also brought this chart. I just wanted to show Andreas on how macro hedge funds are positioned against various indices. Do you think European equities are undervalued here?
Yeah, to some extent, yes. What I like about this setup currently is that we get this bazooka from China. No one's involved in the China trade compared to 2 months ago. As you can see here, Hang Seng is it's got a minus in front of it, meaning that the market is actually net short. The market is net short CAC 40, so the French index. The market is slightly short in IBEX, in DAX, etc., all of the big indices in Europe. So, pretty decent setup for some sort of retracement trade here. I'm not saying that Europe is a good buy with a 5-year horizon, but thankfully we can update you on a running basis in this show, right? So for now, yes, I like the idea of some sort of catch-up play for the rest of the world.
Absolutely, Andreas. We just got a question here on China. I just want to put it in here before we move on to Ethereum in the coming week. The GDX chart looks good this morning following the news out of China. Is a new low in?
Yes, I think a new low is in. You can always discuss when to jump off the train, but it's certainly not yet, if I'm right, that this change of rhetoric on monetary policy is some sort of precursor to a larger fiscal package. You obviously run the risk that they show up with some sort of debt swap or another crappy design for their fiscal package later this week, but they'll have to deliver something. They're not stupid enough not to deliver something this week. I'm 100% certain about that. And if they pull out the big guns, Chinese equities look cheap, but I personally prefer to trade it via proxies such as copper, such as silver. They've got an extremely interesting setup. The market is net short, and you're not as prone to domestic risks as you are in, for example, in buying Shanghai stocks, right? So that would be my take on that. But yes, I think the China story has bottomed here, again, on a tactical basis.
Okay, Andreas, let's take a little look at the week ahead, because we have a bunch of interesting numbers and releases. First of all, the small and medium-sized businesses survey, the NFIB, coming in here. I saw this chart, which saw, to me, a quite mystifying gap opening up between actual earning and hiring plans. Does this mean that the businesses can't get the employees they want, or what do you see out of this?
So, this has been the big puzzle, basically, a couple of years in a row, right? Why haven't we seen weaker labor market data, and given that the earnings cycle has not been super strong, actually, right? And I guess it relates to what happened during 21-22, right? You remember this very clearly as well, Mikkel. We ran a business together during this period. And it was kind of tricky to recruit for quite a long while, right? And wage expectations were through the roof at a point there, and to some extent still. We've actually seen some signs of wage expectations rising again now. So I guess this is a symptom of business owners, stuck between a rock and a hard place when it comes to the whole labor market discussion, because they currently have probably a decent amount of skilled employees that they would like to keep on board, because it's tricky to get hold of them again if they need them in the future, right? Because, they've kept more employees employed than they should, given the earnings cycle. That's also the conclusion from this chart, right? What we don't know is whether the lead and lag between earnings and labor market numbers, whether that's pattern or has changed since 21. I think it's feasible that it has, so that we get weaker labor market numbers in the next quarter or two. But we'll ultimately have to wait and see. My best guess is, yes, we get lower bond yields, we get weaker labor market numbers, but equities will thrive. Because equities are forward-looking while decision makers are backward-looking.
Very fair point, Andreas. Just moving on, we've got the US CPI on Wednesday. Am I right there?
Yes.
You put up this this chart of traded in inflation and the expectation from the CPI. What's your expectations for those numbers?
So I think the market consensus is around 0.3% for the market, or for the November inflation, out of the US. And we've seen roughly 0.3% inflation for a while now again. And if you annualize that, like 12 times 0.3, we're getting clearly above 3%, right? Above 3.5 even, right?
Yeah.
So we're not back to 2% inflation in the US. That's the first conclusion.
No.
And, this is the traded fixing. And for those of you who are not familiar with the concept, it's basically a market where market participants are trying to predict the actual month-over-month inflation increase. So 0.27 means, well, close to 0.3% inflation again this month. For good and for bad, the Federal Reserve has basically accepted that they're not at 2%, and they cut anyway. And I've been saying this on Real Vision and elsewhere for a long while. Forget about that 2% inflation target. It's not really something that they spend a lot of time on anymore. I think there's a very, very simple rule to be made here. As long as we're below 4% inflation, we're good. If we're above 4% inflation, they'll flip again. And as long as we are ranging around, say, 0.25, 0.27 on the month, we're around that 3% mark, and they couldn't care less. Because, they have a debt issue, not necessarily the Federal Reserve, but the US Treasury has got a debt issue. And, well, it's better than nothing to get a little inflation to sort of inflate that away, right? And if, could we care less whether inflation is 2 or 3% as consumers? Now I'm talking for myself, I could I could potentially receive a shitstorm by saying that, but I don't think it matters a whole lot.
No. Not in those levels. I mean, the huge levels we've seen, that crisis that has toppled governments, that's entirely different numbers we're talking.
+5, yeah.
Exactly, yeah. That's where it really begins to hurt. So it's a very good point. Might be looking at some new parameters for that. Let's just touch upon the ECB as well. Are we entering a time for easing of the monetary policy of the ECB, you think?
Yeah, sure. And I mean, they'll cut interest rates on Thursday. I think the big discussion, and that's also why you've brought this chart, I suppose, is whether they'll start adding liquidity at some point next year, because they've been very hell-bent in getting liquidity down in Europe. And, this is the amount of deposits held by governments. So basically the equivalent of the so-called TGA in the US. And, we're close to the lowest level seen in 10 years. Meaning that the governments cannot add more liquidity. They've been adding to try and counter that effect from the ECB, and they cannot add anymore. So we're getting very close to some sort of pain threshold here in Europe. I also think that is what markets have sort of sniffed out, if you know what I mean, that they have to do something here to underpin the bond market. Let's assume that we get a new government in Germany, setting this debt break aside. Issuing a lot more in 25, 26. The ECB will have to play ball. Let's assume that we get stimulus out of France. We don't really know where it ends up politically, but they're certainly not limiting the budget deficit with the new stopgap.
No, not at all. I think they threw out one budget and then introduced another, which I was very surprised about. Seemed to be a lot more loose. But let's see where that all ends.
Yeah. So point in case, yes, there's a stimulus case for Europe as well. There's a stimulus case in China. There's a stimulus case in the US. Ultimately, what we need to watch out for is the 4% inflation rule. We're not there. So for now,
4% is the new 2%.
Yeah. 4% is, and I can prove that empirically if you look back several decades. 4% is the exact inflation number you need to be scared of. Because if you cross that line, central banks will have to do something. And we've seen that over and over historically. And that's bad news for markets, but we're not there. So for now, good news. And then on top of that, stimulus in Europe, stimulus in China, stimulus in the US, stimulus.
Everyone gets stimulus.
This is Opranomics, right? Yeah. Everyone gets a car. You get a car, you get a car, you get a car, you get a car. At some point, this ends up in some sort of sovereign debt crisis again. But we're certainly not there.
Not there yet. When we get there, we might need to look at crypto. So let's just round up with some crypto, Andreas. We've had a question here. I just want to take it, even though it's a little bit special. Emil writing in. You probably won't answer Denmark-specific questions, but I'm curious about the new crypto tax laws coming next year. We've mentioned that a lot on our Danish language podcast. So for you listening to that should be covered. I think they might retrace the plans for for crypto.
Take my word for it.
Yeah.
But I'd like to show a chart on Ethereum before we.
Because I think, Andreas, we've been waiting for this crypto bull run to hit Ethereum. Essentially, it seems like everything else has been entering the banana zone. Are we getting into banana territory here?
On Ethereum, yes.
Yeah.
So I think Bitcoin will, surge to 115, 120K before New Year's, and then we'll probably have a bad start to next year. If you look at the leverage and the open interest in futures in Bitcoin, we saw a material drawdown around that flash crash last week. I think that was very healthy for the market. Now we've seen a slow build-up of positioning again, which is a much more healthy rally. We have seen spillovers to Ethereum. And, was it a month ago, we had all of these memes making the rounds on Twitter and elsewhere on Ethereum holders kind of holding the bag in this crypto cycle. And, it's the same thing we see in every cycle. Bitcoin performs first, and then as soon as the business cycle, ISM manufacturing, for those of you wanting the crystal clear answer, what is the business cycle? It's manufacturing. When that starts to improve, and we've seen early signs of that, we slowly but surely get to the Ethereum season of the crypto rally. So yes, I think we're moving that way. So from Bitcoin to Ethereum to Solana, whatever, right? In that direction. And Ethereum, look at this chart. I mean, it's the perfect technical setup. We're breaking out of the wedge on the top side, and 7K is coming up.
7K, wow.
Best guess, yeah.
Great stuff, Andreas. I think that pretty much sums up our thinking for this week. A lot of very concrete, actionable ideas in here. Anything you want to add before we round off, Andreas?
Tune into the State of the Union tomorrow. It's a slightly cocky title, actually, now that I think about it, right? It's like I'm the president of something. I'm certainly not the president of anything, but outside of my own holding company, but I'm the only one involved in it.
There are so many layers to union. I mean, we talked about that's obviously the European Union, but I mean the US is a union as well, and our landlord here is a trade union. So I don't know.
Oh, Jesus Christ! Don't mention that.
So many layers to this.
Yeah.
Anyway, Andreas,
but I'll make sure to do a flash update once we get some more news from China, because this is potentially very big. That gives you a clue about what we talked about in the Christmas party on Friday. Wow. Very big.
Huge.
Stimulus will have to arrive this week in China. Otherwise, all hell breaks loose, because they've again delivered that rhetorical change to their stance on monetary policy. And even though moderately loose sounds boring, it's actually a big deal, because it was the exact same message they gave 3 days ahead of pulling out the big guns back in 2008. And it was a part of forming the bottom in markets back then. And I suppose that we'll get some very solid positive spillovers from China doing stimulus again this time.
Very interesting. That's all for this week's Bazooka News. We'll be back next week. Thanks to you, Andreas, for joining, and thanks to everyone for tuning in. We'll be back next week.